Good afternoon, everybody. Welcome to the Liberty Call for Wednesday, June 8th, 2022. Hope everybody's having a great day out there. I apologize for being a little late. Had to run into town this afternoon to get some new tires on the truck. So been 6 years. I figured it was time for some new wheels or some new shoes on Old Blue. So again, hope everybody's having a great day. If it's your first time watching, give me a big old thumbs up, a like, a share, subscribe, all that good stuff. I would greatly appreciate it. All right, well, let's go ahead and jump into today's numbers. Not the best day in the market, unfortunately. Looks like we gave up most of the last couple days' growth. So looks like the Dow Jones finished down 0.81% at 32,910. The S&P 500 was down 1.08%, closed at 4115. NASDAQ down 0.73%, closed at 12,086. All caps are down 1.5%. The VIX also retreated 0.25% today. Again, kind of shocking with the market being down. It's currently sitting at 23.96. All right, moving over to the other exchanges here in the Americas. Canada was down 0.65. Brazil down 1.55. Mexico down 0.64. Moving on over to Europe. Germany was down 0.76. The UK was flat at down 0.08. France down 0.8. Euro stocks down 0.47. The Netherlands up 0.26. Spain finished flat at up 0.01. Italy down 0.53. Switzerland down 0.58. Portugal down 0.23. Belgium down 0.1. Let's see here. Let's move on down a little further. The Russian exchanges were both up. The MOEX was up 1.19%. RTSI was up 4.3%. Pretty big there. Heading on down to the Asian markets, they look like they were mostly green today. Japan was up 1.04%, Australia up 0.36%, New Zealand up 0.58%. The Shanghai in China was up 0.68%, the SDSE component up 0.82%, the China A50 up 1.27%, DJ Shanghai up 0.71%, and the Hang Seng up 2.24%, and the Taiwan weighted came in at up 0.95. So looking across the day, it looks like the Asian markets, I'd say they were up 0.5%, and the highest being 2.25%. But the rest of the markets across the world were pretty beat up, especially here in the U.S. So again, not really shocking if you've been paying attention, but is what it is. All righty, well, let's go ahead and read through today's market recap. Dow slips as Intel caution, rising bond yields Dent Tech. Let me shrink that back to normal. All right, the Dow fell Wednesday as an Intel-led dent in tech stocks and ongoing worries about an economic stumble on the horizon amid rampant inflation weighed on sentiment. Intel ended the day more than 5% down after the chipmaker touted in, quote, incrementally more cautious, end quote, view on its near-term outlook amid pressure from falling demand as outlook cut inventory levels. I'm sorry, as clients cut inventory levels. All right, the downbeat remarks triggered a wave of downgrades from analysts on Wall Street and soured sentiment on chip stocks, which fell nearly 3% midday. The broader tech sector, meanwhile, was under pressure by a fresh climb in Treasury yields, with the 10-year topping 3% amid ongoing bets for the Federal Reserve to stay the course on rate hikes to tackle inflation, just as cracks appear in the economy. Mortgage demand in May slumped to the lowest level in 22 years following a jump in mortgage rates, fueled by Fed rate hikes. More on that to come. Twitter, however, bucked the trend lower, rising about 1% as the social media company is reportedly willing to give Musk the information demanded on fake user and spam accounts on the social media platform. See, I told you yesterday this was a leverage on Musk's part. Earlier in the week, Musk threatened to walk away from the deal after alleging the social media company's unwillingness to provide the data had materially breached the deal terms. The earnings front, meanwhile, offered further evidence that inflation pressures continue to build. Campbell's Soup, good, raised its full-year profit guidance after reporting quarterly results that beat both the top and bottom lines, though it said it expects core inflation to run above its outlook. Its shares were up about 2%. Robinhood, down nearly 4%, added to the losses from a day earlier after the Securities and Exchange Commission Chair Gary Gensler unveiled a plan to change how retail stock trades are executed that many fear could dent the trading platform's growth. Under the plan, Gensler proposed that trading firms would compete to handle trades from retail investors. Energy was the only sector to end the day above the flat line as oil prices jumped following a mixed weekly U.S. petroleum report showing an expected build in crude stocks, but a draw in gasoline inventories. ExxonMobil topped $100 a share to close the day at record highs. So, some good news, some bad news, is kind of what it is. With Twitter, I figured Musk's pretty much going to get his way. He's got that board over over a barrel at this point. So I figure he's probably going to either expose them for the fraud that's in the company, or he's going to get a better price on his purchase. So, all right. Moving on to the next article, mortgage applications crashed to 22-year low as monthly payments rocket higher. This comes from Zero Hedge. Another week, another collapse in the pace of mortgage applications as the Mortgage Bankers Association reports a 6.5 over week drop in mortgage applications, the fourth straight weekly drop, its lowest since 2000. Purchases fell more than refis, tumbling 6.1% week over week. Refis fell 5.6% week over week. And you can see here in this first chart that mortgage applications are at their lowest levels since back in 2000. So again, it is to be expected. You raise interest rates, you're going to cool the demand for housing. Outside of the COVID lockdown collapse in mortgage applications, where offices were forced to close by the government, this is the weakest level for purchase applications since November of 2016. This should be no surprise since, as political calculations details, after reaching a new low for affordability in March of 2022, the median new home in the U.S. became less affordable after the typical American household in April of 2022. That's especially clear in the following chart. It shows the basic mortgage payment for a medium new home as a percentage of median household income rocketed up from 33.8% of that income in March to 37.8% in April of 2022. And you can see that here in this chart where it actually had kind of bottomed out in 2020 because as you lowered interest rates, you made the same home cheaper for the person getting a mortgage, and took up a smaller chunk of their household incomes. I think it looks like here it was down to about 24.5%. And again, you can see here like the last peak we had in right before the mortgage crisis in 2006. So again, we can see where it peaked. It probably will fall off at some point, and we'll be back in line. Things, either housing prices will have to come back down, or at some point down the road, interest rates will have to come down to create the same level of affordability. Our next chart confirms the raw affordability of new homes has achieved a new record low. You can see that here. April's 2022 median household income was just 17.4% of the value of the median new home sold during the month. By this raw measure, new homes have never been less affordable for the period where we have data available. Quote, weakness in both purchase and refinance applications pushed the market down to its lowest level in 22 years. The 30-year fixed rate increased to 5.4%. After 3 consecutive declines. While rates were still lower than they were 4 weeks ago, they remain high enough to still suppress refinance activity. Only government refinances saw a slight increase last week, said Joel Can, MBA's Associate Vice President of Economic and Industry Forecasting. Quote, the purchase market has suffered from persistently low housing inventory and the jump in mortgage rates over the past 2 months. These worsening affordability challenges have been particularly hard on prospective first-time buyers, end quote. How much pain will Powell inflict or be allowed to inflict by the White House before he folds? So, and that's kind of the $10 million question is, I guess $30 billion if you count all the debt we got in this country, but, trillion, billions, trillions. But personally, I think you'll cave in at some point when unemployment gets out of control. And, and probably, when the stock market starts to take a nosedive with the slowdown in productive activity in the economy. So again, we'll see. I hope, he's got the guts to stay the course, but I don't have a lot of faith in someone who works for the government, unfortunately. All right, last article here. Shocking consumer credit numbers. Everyone maxing out their credit card ahead of the recession. While it's traditionally viewed as a B-grade economic indicator, the April Consumer Credit Report from the Federal Reserve was another shocker, especially after last month's stunning surge in credit card debt, which saw the biggest increase in revolving credit on record, which is why we said that today's G19 print straight from the Fed would be just as important as Friday's CPI print. And again, you can see here on this chart where the spending, here, let me blow this up for you so you can see it a little bit better. You can see here, this was the last month of reporting, and huge spike. We did have a bunch of months where people were getting out of debt or paying down their consumer credit shortly after all those stimmy checks hit the population, but it's slowly been creeping up here, and then boom. So again, we'll see what happens there. So, all right, and sure enough, it was. While again confirming what we've been saying for a month, any excess savings accumulated by the U.S. middle class are long gone, and in their place have unleashed a credit card-fueled spending spree. Here are some shocking numbers. In April, 1 month after the jarring March print again came in more than double the $25 billion expected to $52.435 billion. In April, the consumer credit again exploded to a ridiculous $38.1 billion, again blowing away the expectations of $35 billion increase, and much lower than last month's downward revision, or downward revised $47.3 billion. And while non-revolving credit, student and car loans rose by a relatively pedestrian $21.1 billion, which is still the sixth highest on record. The stunner for the third month in a row was revolving or credit card debt, which remained shockingly high, rising by the second highest on record at $17.8 billion, and down from only the highest print on record. March's downward revised $25.6 billion from $31.4 billion, and sending total revolving consumer credit back to new all-time highs, just over $1.1 trillion, erasing all the post-COVID credit card deleveraging just in time for those credit card APRs to start moving much higher, first slowly and then very fast. As an aside, and while not at all surprising, both auto and student loans hit a new all-time high at the end of the first quarter. While this unprecedented rush to buy everything on credit at a time when there were no notable hallmark holidays should not come as much of a surprise. After all, we have repeatedly shown that for the middle class, any, quote, excess savings are now long gone, with the personal savings rate plunging to the lowest since just before Lehman. And you can see that here. Goes back more than a decade. The fact is that most economists, such as those at Goldman Sachs, had previously anticipated the continuing spending of savings by consumers is what will keep the U.S. economy levitating in 2022. Unfortunately, as the consumer credit numbers of the past 3 months demonstrate all too clearly, any savings that the middle class households may have stored away courtesy of stimmies are long gone. The implications are profound. Any model that projected that U.S. spending was fueled by, quote, savings can now be trashed. And since this is most of them, the consequences are dire, as they confirm once again the Fed is tapering, quantitative easing, and hiking right into a consumer-driven recession, which was not visible until new precisely was. I'm sorry, let me start over. Consumer-driven recession, which was not visible until new precisely because of all the credit card-fueled spending, which according to Deutsche Bank will begin in late 2023, which according to Morgan Stanley can start as little as 3 months. Today's data suggests Morgan Stanley is right. So it's a mess. People are racking up the debt, going into a credit squeeze, and it looks like if on those revolving debts, you're probably going to be paying much higher interest rates. So I'd suggest paying those off as quickly as possible. You really don't want to be over leveraged heading into a recession. You want to be able to have a lot of dry powder available. And unfortunately, I think most consumers aren't thinking that far ahead. So, all right. Well, that's everything I had for today. Hope everyone has a fantastic evening. If anybody needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. And hope everybody has a fantastic evening. Bye-bye.